Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, look at some information. I'll interject my financial opinion in with it. And if you guys want to follow me on Twitter, it's at finding_finance. If you want to follow me. So this is all going to be commodity related. It's all going to be related to things that I talk about on the channel. So we'll dive in here. I'll give you my financial opinion and we're going to jump right into it. So here is the good old Twitter. So it says, Fed's bullard. The United States has a serious inflation issue. Yeah, they're also going to be walking into a bond issue as well, I think. But yeah, we already know that. Here's SRS Rocco report. It says oil and petroleum fuels have allowed global metals production to increase significantly in the past 50 years, but this is about to end. Peak oil equals peak metals. Got physical gold and silver. So more or less, the growth in energy allowed the growth in metals and whatever else growth in terms of gross domestic product. So metals is more or less just the conversion of energy to metals. That's all it is. We are converting energy into metals and usable products. This is copper, silver, gold. You can see, obviously, the relationship of energy growth and the production growth of metals. And a lot of the companies that produce metals, if you look at the mining companies, about 35 to 50% of their costs are from energy. But what people tend to forget is that it's not the cost of things, it's the expenditure of energy. I mean, you could have the cost go up, but if the energy doesn't exist, cost doesn't matter. It's energy driven. Here's the tech versus the S&P 500 price relative. So think tech versus S&P 500, and that's obviously rolling over in terms of tech versus S&P, which I thought was kind of a cool chart, topping patterns. These topping patterns, if you notice the dates, look at the dates. Early 70s, late 60s, early 70s, rolling over. 2000, rolling over. And then we're rolling over today. Those were also analogous to the beginning of commodity bull markets. Yeah, it's all in alignment, isn't it? It's crazy when you start looking at history through a certain set of glasses or paradigms. So that's one important reason to subscribe to the channel here. Looking at Lynn Alden, this is a good chart. From pragmatic standpoint, rather than trying to predict a liquidity reversal in advance, it'll make more sense to watch for an actual catalyst and signs of liquidity reversal. But I thought this was an interesting thing here. It says the global liquidity index long-term cycles. And this thing's been cycling back and forth. And then it shows that we're in a liquidity index that came back down, which could potentially turn back up, which means we're actually not at a very liquid point. And I would agree, we're raising rates, we're kind of stopping and slowing everything down. And that liquidity could reverse higher for whatever reason. I'm not going to sit here and speculate on the reasons. If I were to speculate, I would say the bond market is going to have problems and that all of these bond markets around the world going into problems of basically tanking are going to need liquidity, and that liquidity is going to be created through quantitative easing or whatever else they're going to do. This is the winners in the stagflationary 1970s. This is only the piece of research I printed and kept over the last couple of years. You can even see a coffee stain on it. So what did very well in the 1970s was value, small cap, REITs, commodities, real estate. That's what outperformed the consumer price index during that time frame. Now, one thing that is a little bit crazy here is I think real estate was a big driver. That was in an imbalance, and I think that was the pacing factor of inflation, tied with energy translating that money into the CPI numbers. So inflation and the demographics were the driver from real estate, and energy was the translator of that inflation into the consumer price index. Very similar scenarios to today. And I know there's some 1940s mixed in it. I understand that. We've got the old economy sectors likely to gain weight. The sector weighting in the S&P 500. Right now, it's very tech heavy, and that's starting to decline. And energy, materials, and industrials is very, very low in the S&P 500 weighting, and that's about to turn higher. And we're going to see the alligator jaws start to close over time, I think. We've got bear markets since the Great Depression. We're not really down that much, but that's what they look like over time. We're probably going to head lower here. I can't see a scenario where Europe is going to help the United States. I mean, they're in a pretty dire situation, so I do think that this could potentially head lower in the future, which is basically a direct cause of energy crisis. And that energy crisis can translate into bond market crisis and currency crises. This one I thought was really cool. It says, when you get a range expansion, the market is sending you a very loud, clear signal that the market is getting ready to move in the direction of that expansion. And we see 3 consolidation periods. We see breakouts between these consolidation periods. And what we're doing is we're breaking out of a consolidation period where we can move much, much higher in the commodities super cycle. You can see that these are super cycles, the beginning, the consolidation, the beginning, the consolidation, then we're at the beginning, the breakout of that consolidation breakout. So commodity super cycle, I think, is ahead, and that does scream, it screams inflationary, and it also screams that it's structural by nature. And it's also telling us that we've got an alignment between the tech market going down, a lot of the energy sectors going up, commodity sectors going up, and I think precious metals is going to be a sector that does very well. This is what happens. What happens when they can't drain the strategic reserve any further? What happens when they need to fill the strategic reserve back up? I don't know if they're going to fill it back up. You know, I've got some people asking this. This is the cliff dive. That they're just draining the reserves for, I would consider, political reasons, for elections. But that's what it looks like. That's the reality. And I don't know if they're going to fill them back up. Seems like this administration just wants to use things, abuse things, and not return it back to normal. Frac activity continues to struggle as the Permian plus U.S. core oil are at 175 frac fleets, lowest since February. With inflation running rampant and acreage degradation, extreme volatility and drawdowns in oil pricing are seriously impacted fracking and, in turn, inline operations. And you can see us kind of declining here since 2022. We're basically flat in 2022. We're not really increasing these for the frac spread count. So that's in North America there. We've got Latin American countries are joining a growing list of emerging markets with petroleum demand above 2019 levels and rising. Large populations are moving up the S-curve, which looks like a bigger factor in their energy consumption. This is a massive chart. We've got basically a breakout of energy consumption here for the LATAM clean product imports. So their demand is obviously moving up rapidly. This is also seen in other countries around the world with vast amounts of populations increasing their energy consumption. And I think that we're going to get into a very tight squeeze in energy. So it's coming, and it's going to be inflationary because that is what translates dollars in the system into consumer price index, is energy, as seen in Europe, if you want to get an extreme look there. It says, the less latent supply of commodity there is, the more volatile the price becomes. As inventories fall in silver, platinum, aluminum, oil, etc., the prices will be more volatile in both directions. Just expect and accept it. Overall, this decade, they will be multiples higher. I agree with that, definitely. I said, watch precious metals inventories as the shortages will drive price soon. The banks don't want precious metals to show everyone a problem exists with their currencies. They're going to fight this tooth and nail. They don't want you to see that problem there, guys. They want to hide the problems behind the curtain for as long as they can. I said, power is derived from the currency they can issue, settle in cash as they can print more of that. That is a response to precious metals and the manipulation or the paper price that is associated with controlling that price. But they're going to do whatever they can. Their power is derived from the issuance of the currency and their abilities to spend that currency and have it be a reserve currency. They are going to protect that at all costs. Great investors see the problem before they happen, even when price signals in the short term are telling them otherwise. So basically, that's identifying long-term structural problems and sticking with that thesis or sticking with that paradigm of thought, irrespective of the short-term noise that we see in the day-to-day price movements. That is what great investors see. They see value and they separate the price movements from the value that they see in the market and the opportunities that are there outside of the day-to-day movements. I write, assets are priced off market conditions. Energy shortages and commodity shortages will destroy GDP. Debt must grow by design. The difference between debt growth and GDP is the problem. Hence, not much will work for investing outside of energy and precious metals. So what happens is money, they put a bunch of money into the system. It all went into financial products based off of the market conditions of low inflation, low interest rates. That spawned a gigantic, we'll call it gigantic bubble in stocks and bonds. And now that is all unwinding because of the energy shortages and eventually the commodity shortages in the system. And what that's going to do is it's going to destroy GDP. And that difference between GDP and debt growth is going to be inflationary. And it's going to be a problem because interest rates are going to go up because of that difference. And when interest rates go up, it completely changes the entire market conditions and the pricing of assets. So all that money that was pinned into stocks and bonds is all unwinding. And that great money rotation will find its way into energy and precious metals. Because the ramifications of an energy shortage will, I think, create problems in bonds and currencies eventually. It says, the energy crisis will load up pressure on bonds with higher inflation, leading to higher interest rates. The relief valve is the currencies. Banks will save the bond markets and print currencies. And what I'm saying there is the energy crisis will put pressure on inflation, or it is inflation. That will put pressure on interest rates, and the bond market will crash, much like the UK gilts and the bunds. It'll happen over there in Germany as well. It's going to come to America. I don't know how intense it will be, but the relief valve of all these is usually the currency. The value of the currency is going to blow off to the downside. That is the relief valve of all this pressure that gets built up in the system. And they print currencies to cover their bond markets. That's usually what happens, and it ends up in an inflationary outcome. This is the global research year-to-date annualized return for the 60/40 portfolio, the worst in 100 years. That is basically just saying that the stock market and bond market are eating poop. Now, if you look at these scenarios here, what that is describing is the market conditions. The market conditions of a commodity bull market, at the beginning of a commodity bull market, is this, where it's red there in the early 1970s and late 60s, and also in the 30s, right here. Those time frames where stocks and bonds both go down is when you get an inflationary impulse into the market where interest rates go up at a good pace. It's the beginning of a commodity bull market. And that is the market conditions. That's what it's showing us in this 60-40 portfolio of the annual worst year to date in 100 years. This year, and this year were the beginnings of commodity bull markets. The commodities are causing the pressure. This isn't like the last 40 years. This isn't the end of a it isn't the end of a real estate cycle that's causing this. We're in the middle of a real estate cycle, and the commodity pressure and the inflationary pressures are so strong that it's actually slowing down the real estate market. That's how strong these, I'll call it the impulse move and forces are in the market. And all they're doing is delaying it through the Strategic Petroleum Reserve releases of oil. I don't even want to know what's going to happen next year in terms of those pressures in the market and in oil, because I think it's going to continue to get worse in terms of inflation and the pressures from oil and energy worldwide, that is. To put things into perspective, the average inflation in the world has jumped to 10.2%, the first double-digit increase since the statistics began. Way up there, up 10.16 for the world economy weighted inflation. It is happening worldwide. That's why I wanted to share that. It's a worldwide phenomenon. The gift that keeps on giving. This is the British pound divided by the dollar. And remember when I talked about the bond market? The bond market coming under pressure and the pressure being built in the system. The relief valve is the currency. And when you see the dollar, this is relative strength. The British pound is sacrificing their dollar or their currency for their bond market. That's the pressure relief valve. This is what it looks like. One thing that everyone needs to be aware of is there's a tremendous amount of cash on the sidelines. We don't know where that money is going to go. We just know it's going to go somewhere. We've got that. We've got the macro outlook. You guys definitely need to check that out. But that's what I've got for today, guys. I think that's the end. And all I'm going to say is watch what America does. If we start to see pressures mounting in our bond market, what they're going to do is they're going to relieve the pressure with a devaluation of the currency. That, I think, is what's next. We are starting to see this around the globe of bond markets coming under pressure and then them printing currencies to relieve the pressure in the bond markets. This may put pressure on other countries to print more money and keep everything relatively close to the same. If you don't keep that relativity, what you're going to do is you're going to see the dollar get stronger if they don't print like the other ones do, and you're going to see their currencies dive. So this is all becoming a relative game. It's a relative strength game, and they all need to print at the same rate, roughly, if they were to keep this all relatively the same. If they don't, you're going to see pressure get placed on currencies around the world, and you could see currency crises start to happen. I think what's going to happen is you'll see those start to happen around the world, and eventually it'll come to the dollar last. It is similar to the milkshake dollar theory. It's the same thing as that. And the dollar will, I think, eventually get hit as well. It'll just be towards the end. But that's all I've got, guys. If you guys need help navigating through this, definitely subscribe to the Finding Value website, the Platinum membership. We talk a lot about this. We've got ways to play it. We've got strategies in place that I talk about. At least my strategy, because I share my strategy of what my strategy is in place. You can see my portfolio. You can see what I own, what I'm buying. We did have a Platinum question and answer session here. Just recently, I did post the video on the website. You can see that with the companies that I like. If you guys like this content, give me a thumb up, subscribe to the channel, and we'll catch you next time. This is Finding Value.